What's good, everybody? Happy Tuesday. Welcome to the Doe Show. My name is Dustin Tibbetts. I'm a financial advisor with Jazz Wealth Managers. I hope you'll check us out. We manage retirement investments, long-term investments. We manage our own portfolios. We're fiduciaries. We're SEC registered now as of last month. Not really much more I can say in the way of that. Check us out at jazzwealth.com. Well, today, this sort of Doe Show is about getting your dough straight, and we'll do whatever we can to help you with that. It could be personal finance related, it could be investing related, it could be retirement investing related, anything we could do to help you get your dough straight. And today we're going to talk about stock splits. Have you ever heard of a stock split? Do you know what a stock split is? Well, we're going to cover that. So it hasn't happened in a while. Actually, there hasn't been any name brand stock splits lately. A couple like maybe off brand, but not any of the big names like we saw years ago. But let's just go over it. We'll make this a short one today. A stock split, when it comes up, you will see a significant change in your account. But basically a split means that a normal split means that the stock price is going to divide by some amount overnight, right? Just when you wake up and it's like half the price, but you're going to have twice as many shares. So example would be you own a stock for $200 so I can do easy math on myself here. And let's say the company decides they're going to do let's make it real easy, a 2-for-1 split, okay? And so what it means is they're going to reduce the stock price to $100 overnight, but they're going to give you twice as many shares. So let's say you own one share of this stock, whatever it is, for $200. You would wake up the next day and you would own 2 shares of a $100 stock, but it's the same thing, right? So the notional value stays the same, meaning you spent $200 to own one share. Now you own 2 shares of $100, but you still have spent $200. So that's an easy way to explain it. But companies don't always do it really in a nice, simple way. Sometimes they'll do like a 3.5-for-1 split. Some of the lower no-name companies do that. Now, why would a company do this? Why would you wake up one day and the stock was $200, now it's $100, and you own twice as many shares? The reason for that is, the public reason is liquidity, right? So a lot of times a company will come out and say, look, our stock price is sort of expensive. We want to go with twice as many shares for half the share price in hopes of attracting investors that just simply couldn't afford or weren't interested in a $200 stock. So a lot of times the company will just do that to attract more investors. That's what they say anyways. A couple of the real reasons. So one of the real reasons is when a stock price appreciates rapidly, it gets harder and harder to attract more and more people to the stock. And so what they'll do is they'll reduce the stock, or they'll do a stock split, and they'll say, we're doing this because our stock price is really not attractive to the everyday investor. When in reality, when a stock split hits, it gets a lot of media attention. It makes people realize this stock is moving. This stock is going higher faster, and now that it's half the price, I'd like to dive in and see if that happens again. That happens more than you think, and there's actually a lot of studies done by Wall Street to show the psychological impact of doing a stock split when it's appropriate, and it really does attract the average everyday retail investor. I mean, look at the pot stocks. Look at just a couple days on TV and everybody's interested in pot stocks. A little bit on Bitcoin and all of a sudden everybody's interested in Bitcoin. So it's a great, psychological trick that they play. Now, it can also be status, by the way. So while this may be to attract the public and to make it more attractive to people, it can also be what we call status symbol for the company. And a great example, I think Financial Investor beat me to it there, very nice. A great example was Apple. And what happened was Apple's stock price was like $690 something. I'm going to call it 700 just to be exact, or just to be a little rough there. But it was in the 600s, 656, 659, something like that. And Apple was faced with a real problem. Now, Wall Street picked up on this right away. The retail public was like, look, I'm trying to buy Apple here at $700 a share. I can't, it's too expensive. Fractional shares, I don't think were really around at this point. This was 2014. If they were just starting to make their their entrance into the world. So you had to have $700 to buy one share for the most part. So Apple was like, okay, publicly, they're like, we realize it's too expensive. We're going to do a 7-for-1 stock split. And what happened is overnight, everybody, their shares went from 700 to 100, but you had 7 times as many shares. Okay? Now, why did they choose that number? That was what was interesting, is a lot of people were like, okay, that's crazy. I don't understand why they would go from 700 to 100. Why not from 700 to $50? Or why not from 700 to $250? Why did they go from 700 to 100? Well, that's the status symbol. See, if you do a little research, what happens is Apple, Tim Cook was the CEO at that point. Tim Cook was dying to be a Dow stock. And Steve Jobs never wanted to do that. And so he just kind of plowed through life with the stock price appreciating. He said, leave everybody behind. We're a growing company. You jump on board or you don't play along. And Tim Cook said, look, you got to get the masses involved. We're not going to be growing at this speed for the rest of our lives. So he wanted to get in the Dow 30. The problem is the Dow 30 is a price-weighted index, meaning he who has the highest price per share is the dominant focus in that index, unlike the other indices. So we talk about index funds and things like that all the time. This is another thing that you should know about the indexes that you're choosing. So Apple was like, no way, right? The Dow's not going to invite us into their mix if we're immediately the dominant factor in there. Think about it. If you go, like you're on a bowling team or something with your friends or whatever it may be, or maybe you're on a softball team. We do softball here at Jazz. Imagine if I showed up to a new softball team with the baddest of all the equipment. I was the best player. I was cocky. I was arrogant. You're not going to get invited on that team, right? You have to show up and sort of prove yourselves and be thankful to be a part of the team and thank everybody for inviting them. Well, Tim Cook wanted to be in the Dow. And the Dow wasn't even going to look at them because they would have been the most dominant, cocky, expensive product in the Dow. And they won't have that. They don't have a history of inviting people that immediately are the biggest price stock in the index. So Apple chose this number because their share price actually went to like $96 or $98 or something like that, which put them just under being the most dominant player in the Dow index, Dow 30 index. So it allowed the Dow to now look over here and go, oh, okay, you guys are willing to play the game a little bit. It's a win-win for Apple because more people could now buy the stock, and now Apple could be in the Dow and become more of a, just a regular old, not a growth stock anymore, but more of an income type stock. So that's exactly why Apple did that. And so for that reason, it was a status symbol. So publicly, they said, we want more people to participate, blah, blah, blah. They weren't paying a dividend at the time, so there was no real reason that people would really participate more. But financial media was like, bet you they're going to be in the Dow. I'll bet you anything. That's why they're doing that. That's why they picked this stock price from $6.90 something down to $96. So it was a pretty interesting story. Now, here's the thing. I rambled a little bit there. That's a stock split. So a stock split means you have... You're gonna have, well, it depends on the split amount, but you're gonna have less on price, but you're gonna have more shares, right? So you're going to wake up one day on a stock that does a stock split, it's going to be worth less, some fraction, whatever the divisor is there, whether it's a 2-for-1, 7-for-1 like Apple did, and you're going to end up with more shares relative to the amount that they lowered that stock price. Now, there can be a reverse split also, if I can confuse you for a second, where you're going to have less shares, right? But the price is going up. So this would be the exact opposite. They call that a reverse split. And this is where you would say like 1 for 2, right? So you have, in this example, maybe you have a stock that's $5 and they want to make the stock $50. So they do 1 for 10 and now the stock price is $50. This would be a 1 for 10 reverse split. And so what happens is you had, say, 100 shares at $5. Now you end up with 10 shares at $50. The notional value is still the same. You spent $500 to acquire 100 shares of this stock, but in the morning, now you have 10 shares at $50. It's still $500. Your cost, what do they call it? Your notional value, your buying power, your margin, if you're participating in that, this is assuming no margin, is now $50, okay? So, Why would anybody do that? Well, there's a couple really cool reasons, and I know I look like all young and handsome and stuff, but I came from pre-2008. I got started doing this in the 90s, and so I've been doing this all through high school and college and everything. So I got to participate in a lot of the fun. In 2008, 9, and 10, I was actually teaching traders all over the world live. Like, I was trading in front of them. I would tell everybody when to buy and sell, and one of the cool things that came up was a company called Citigroup. You know Citigroup, right? So let's do this as an example here. Citigroup, what happened was during the financial crisis, their stock was trading between like $4 and $6, right? And you go, well, Dustin, that's an awfully wide range. How were they trading behind Citigroup? How were they trading in a $4 to $6 range? Things were that volatile, right? Stocks that were $4 were moving 50 cents every few minutes. And so think about what happened there. If you're a day trader, if you were a day trader back in the day, 09 and 2010, 11 and so on, if you were a day trader and you found, let's say, a $5 stock that would move 50 cents or more just every minute, just wiggling around like that, would you rather participate in a $5 stock that was super volatile or a $100 stock, if you could find them at that time, that was less volatile? So over here, this stock's going like this, price-wise, all day long, just crazy, crazy. And over here, this one was kind of wild too, but not as much. Even if it was larger, which one would you participate in if you're a day trader? Even if this one was exactly the same, you would still participate in this stock. And the reason for that is because it's only $5. So if you weren't using margin at all, which you have to if you're going to day trade, but let's just say, to make it easy, you bought 1,000 shares of a $5 stock. Cost you $5,000, right? You buy 1,000 shares of a $100 stock. I don't need to do the math for you. You see the price difference right there, right? So every day trader was like, screw this. I'm going to go over here and I'm going to day trade this one. It costs me less and I have the potential to make more. If I can make 50 cents on 1,000 shares, that's $500, right? It only cost me 5,000. That's a 10% gain just from day trading a $5 stock, where over here, I might have a fraction of a percent gain and I'm risking so much more money. I'm tying up more capital. So what happened is, on Citigroup, the day traders all came over here. I was one of them. We went over here and we said, for $5, I'm going to day trade this thing all day long. And it would wiggle around. Citigroup was pissed, right? Citigroup sent out notices. They kept telling everybody, stop, quit day trading our stock. We don't want day traders. And nobody cared, right? We just kept buying and selling and buying and selling. So Citigroup said, you know what? Screw you guys. We are going to do a 10-for-1 reverse split. They took their stock that was trading somewhere between $4 and $6, and overnight it started trading between 40 and 60. I think it was 47. I have 47 stuck in my head for some reason. So they did a 10-for-1 reverse split just because they wanted to. So overnight, all of these day traders were shut down, right? And what happened? The stock was now more expensive and it started trading more normally, because people were like, okay, fine. If you're going to reverse split the stock on us, we're going to go find something else to trade. And that's why, in this case, that company did a reverse split. So that's one example that I thought was really cool, and it just brought back some old memories from yesteryear. But that's Citigroup. Now, what's another example if you're still interested? Is anybody still watching? Like, am I just rambling? I know this is like sort of boring for some people, but I'm really excited by it. Okay, another reason why a stock would do a reverse split. Here's a company you've heard of before, Sirius. Siri. I'll go XM so you guys don't think I'm talking about Apple, the little Siri thing on the phone. Here's what happened with Siri. So Siri did a reverse split a long time ago because Rebate Traders were going nuts on their stock. So if you're familiar with day trading, you know what that is. Have you ever heard of rebate trading? That was something that a lot of day traders did. So Sirius XM, the stock was trading at like $1.10, okay? And it didn't move at all, right? It was just flat. It would trade $1.10, $1.11, $1.10, $1.11, $1.09 maybe, $1.10 all day long. But yet it traded hundreds of millions of shares a day. And so I used to get the question a lot, who's trading this stock if it only moves a penny all day long? And that's what's called rebate traders. It was really, really popular for a long time. It's still out there. It's just not as common because companies, they're pretty quick to figure it out. But essentially it was traders gaming the system. Check it out. So if you had a stock that traded $1.11 by $1.10 by $1.11 all day, meaning this was the bid and this was the ask. You guys familiar with that? Right? And all day you just kept seeing people go, I'll do $1.11, I'll do $1.10, I'll do $1.10 and a half, I'll do $1.10 and an eighth, I'll do $1.10 and a quarter, and then you have these people going, I'll do $1.10 and 3/4, I'll do $1.10 and 5/8 or whatever it was. So they were constantly making these deals. Well, here's what happens. If you're a rebate trader, if you place your order a certain way, you can get credited 0.0025. At least that's what it was at the time. I don't know what it is now. It's probably something very similar. You would get a credit to you of that per share. Think about it. All you had to do was place the order on the exchange, and as you place that order, if someone came and took it up, they would give you this money. It was free. The exchange would just give you the money, you'd see it in your account, and it was great. However, that's not a lot, right? It doesn't seem like a lot because everybody's like, wait a minute, it costs like $5 to trade, $6 to trade. So what? You get a little bit of a break there. Your net all-in cost of these rebate traders is 0.001. Well, 0.001 really was their all-in cost. So if it only costs you 0.001, and just for putting the orders out there, you're getting 0.025 per share, right? Then technically you could make money just by placing orders all day long. You crypto people think you've got it figured out. These guys have it figured out, or had it figured out. So what happened was people would put millions of shares to buy and millions of shares to sell, right? So over here, you might see 100, 200 million shares on the bid because it's only $1.10, right? So to put one share out there to buy is $1.10. To put 1,000, 10,000 and so on and so on, it was so cheap. And so hundreds of millions of shares were trading hands all day long on this one stock simply to get the net benefit of 0.0015 per share. They could care less if the stock ever went up or down. They were making their money this way. It was really, really cool. I know a guy, he was making $7,500 a day. And as soon as he made $7,500, he would shut it down. That was his magic number. He lives on the other coast of Florida, actually. And to this day, if you want to know, he is 1/3 of the volume of one of the biggest stocks out there. All he does, he sits in his very, very nice house and he buys and sells one stock all day long. It's a very, very big stock. I could say the stock. It's UTX, United Technologies. He buys and sells the stock, and he is on record as being the third largest, or he's 1/3 of the volume every day because he buys and sells and buys and sells and buys and sells. That's all he does. That's his job. Anyways, at this time, he was making $7,500 a day simply by putting as many orders as he could stack up here, and then at the same time stacking up as many orders as he could here. So he was a buyer and a seller at the exact same time. Well, anyways, not to go into a whole lot of that. What happened was Sirius was like, come on, guys, quit messing with our stock. We can't get our stock to go up or down because there are hundreds of millions of shares trading each day on both sides. There was never any demand for buyers, and there was never any real demand for people to sell. Everybody was just there for the rebate. And so Siri did a reverse split to try to get away from that. And so to this day, you can't really do it on that stock. So that was it, right? That was the Sprint. Yeah, Sprint was one of them for a while too. Sprint did it way back though. That was a long time ago. And so that's a great example of why stocks do reverse splits. They're either trying to avoid something, trying to get out of something, or it could be also, I think I left it out, it could be that they're trying to get more recognition. If you're like a dollar stock, like if Jazz Wealth went public, nobody would care. We'd be like a little piddly little stock. And so if I wanted to get more attention and had a real business to push and promote and get in front of TV and everything, I would do a reverse split. And maybe the stock was $1. I'd try to make it worth $10 because now it's on the radar of more and more investors, more mutual funds, more institutions. People will take a second look. Now, if they take a look and they find there's nothing there, it's not a real business or it doesn't make any sense, then they wouldn't invest. But a lot of times when companies are just getting going, they'll stay small and kind of under the radar, and when they've got real revenues, real things to promote, then they'll do the reverse split, and all of a sudden people start looking and going, oh, this is a really good business, good job. You got a lot of customers, whatever you sell or whatever's happening, they get excited by it. So that's another reason. I feel like I talked a lot. Yeah, I did talk a lot. I'm sorry about that. So I probably missed any questions. Yeah, today is basically just like an overview. We did cover the reverse splits. Nice. Glad you guys got that. Perfect. Yeah, not bad. These days, yep, fractional shares. We have fractional shares here at Jazz. So every customer, it starts with $100. If the stock was $200, you'd still be participating in that stock, or spread out, of course. So fractional shares are pretty common these days, but back then they definitely weren't. Good. I'm glad you like it. I like it. The closer you get to retirement, the more you're interested you get in day trading. Are you crazy? Actually, a lot of the people that I taught were retired. They had that part of their lives taken care of. They had a little money and they were just trying to stay engaged. They were not the I want to get rich day trading people. They were just people that needed something to do and really found an interest in the market. So I know the day trading environment gets like a bad rap from like the crypto people and like, oh, it's just these kids that are faking it. They're not really millionaire. Nobody's millionaire. I'm sorry, but they get that impression of it. But actually, I mean, I've seriously taught well over 10,000 people day trading over the years, and most of the people are just normal people that just like to be engaged. They just like to buy a little something, sell something, and then they go about their day. Except for the Chinese. You guys are crazy. I've taught a lot of Chinese day traders, and they like to play the game. So I give them credit for that. They are engaged. Anyways, yeah, you got a couple others you listen there for reverse splits. Yep, certainly. And so it's coming up more and more with the likes of like Amazon trading where it's trading and stuff. But there are some companies that just don't believe in it. Now, Amazon will get to a point just like Apple, by the way. So right now, everybody's like, look at Amazon grow. Look how crazy it's going. At some point, they're going to have to accept that they're no longer a growth company. They've run out of things to dominate. I think we're a ways away from that, but they'll do the same thing as Apple. Apple has sold something to everybody on this planet. And so now it's a matter of, okay, let's just keep our base and keep generating income from them. We don't need to grow at such crazy paces. So we'll talk about it as it happens. Yeah, yeah, you work at nights, you want something to do during the day. That's cool. I like it. Anyways, all right, I'm gonna wrap it up from there. I appreciate you guys watching today, and if I helped you in some way, you didn't know anything about this before we started, hit the subscribe button. Let us know. You don't have to turn the bell on, but hit the subscribe button. I appreciate it. And we'll see you again at 5 o'clock for the closing beat. I've got a lot of interesting things I want to share today about the stock market, and we'll talk to you then.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.